so have a look at them after the lecture. Please take your results. There's just some feedback on your progress, nothing more or nothing less. Okay? For many of you, and I'll go so far as to say most of you, the feedback will be relatively positive. The average was about where it has been in the past, maybe a little bit higher. And so, you know, don't take this as a necessary sign to panic if it wasn't quite what you wanted. By all means, come and see me. I'll organise a time in the coming weeks where I'll get someone to sit in a room. It might be me, it might not be. And I'll have some solutions there, and you can come in and you can have a look at your paper and you can see where you went wrong and you can move on. All right, a little bit of closure. I don't necessarily buy into the fact that will give you anything, any extra information, but I do respect the right and your wish to review your paper. Why I say it won't give you anything is because by the time you review it, the knowledge in the test is so far kind of assumed, and we've moved on. I don't test you again on the same things. But it is important for you to make sure that you're comfortable with what you know, what you don't know, where you made the errors and things like that. So stay tuned. I'm going to write to everyone and say, you know, there'll be a couple of hours here or there where there'll be someone available. So the reason we do it that way is because if we make individual times, then 360 times half an hour starts to become pretty tough to make work, all right, in terms of time for us and time for you and organising and logistics and things like that. So I hope that was okay. Workshops this week, so I've worked with some groups already and I've got another one later on. I think, certainly from my perspective, I think the vibe in the room when people have gone through the workshop questions has been pretty positive. So you know enough, you're getting enough assurance that you know enough already to have a reasonable go at most parts of most of the question, the key question. I don't expect you guys to be able to do it without any guidance. That is very clear and it's genuine. It is reasonable, though, the way we set the questions up and the way we set the course up, it is reasonable to expect you to be able to have that knowledge and comfort within 6 weeks or so, i.e. by the time the end of semester comes. We will be plying you with more examples of questions like this because there will be a question like this on the exam. And I can tell you it's even going to be question 2. All right, so you'll notice, I think, that most workshops you'll go through not only the solution but the process of getting your heads around how to do these questions rather than just necessarily worrying about getting the right numbers down. Okay? I've also, this is the last bit of housekeeping, I've also put up a series of short videos that may or may not help you. They were shot for a different purpose, so they were shot by one of my colleagues in the department just to provide some general insights and general sort of background to accounting for those who don't know much about accounting. They might be a bit too simplistic for you guys. They might or they might help you, or they might be a bit of both. By all means, look at them. If you've got any questions about them, it's just you know, my colleague Michael, who's presenting some general information about accounting. It's not going to hurt you to look at them. They're about, I don't know how long they are, 6 to 12 minutes long. Some, you know, they vary in length. Check them out if you want to. Don't if you don't want to. They're there for you. Okay? All right. So, last week before Easter. Anyone eating hot cross buns already? No? Ah, yeah. Thank you. There's one person that told the truth. No, not one person. There's a few. All right. So, let me sort of introduce today's topic. Analysing non-current assets. So, you know, again, like we've been talking about with inventory and things like that, I want to talk to you about some issues relevant to managing and recording and reporting non-current assets. I'll finish off with a little bit of a chat about how to evaluate and how to figure out whether companies aren't doing the right thing with their non-current assets. And yeah, we'll just explore a few issues and we'll see how we go. One thing that we're going to explore, though, is relevant to the question that you're doing in this week's workshops. So there's actually a bit of knowledge in this week's workshop question that you need from tonight's lecture. So it makes it hard for those that have already had the workshop, but from the workshop next onwards, you should be right. Chapter 8 in the textbook is the way to go, is the relevant reference as well. So a few learning objectives, and I'll leave you to explore these yourself. But there's three probably that are clearly new for this week. All right, explain the concept of depreciation, and be able to apply depreciation using three different methods: straight line, reducing balance, and units of production or units of use. We're going to spend a little bit of time on the mechanics, not too much at all, because I think the mechanics are fairly simple. It's going to be more about the choice of depreciation, or choice of depreciation method, what information you need to make the choice and apply the method, and what does it mean for the bottom line figures. How do you deal with subsequent expenditures? So once you buy an asset, we need to work out the cost. I think we can do that because we've done it for inventory, etc. So that's the first one, right? But what happens once you've bought the asset and you spend more money on it? What choices do you have to make then? What about revaluation and disposal? How does that work? And then there's a couple at the end here, evaluating the use of non-current assets, a couple of ratios. And I'm going to introduce intangible assets, I think, which I've introduced already. A little bit more information about them, but in terms of the most new information, it's probably going to be 2, 3 and 4. Okay, so they're the ones to focus on this week. All right, so let's do it. So non-current, let's not do it. Hang on, finger trouble. There we go, look at that. So non-current assets. So think about the importance of them for an organisation. So I'm talking about obviously assets other than current assets, and why an organisation might think that these are important. So, maybe think about them in terms of some of the organisations you know. The non-current assets are the key part of the organisation, or the key part of the strategy of the organisation that might enable them to put together some infrastructure to enable them to operate long term. So what property, plant and equipment do you have? Where do you build your sites? Do you make your key factors, your key inputs to production, or do you lease them, or do you buy them from somewhere else? How do you set yourself up to give yourself the greatest chance for long-term success? Reducing and managing your risk. If you are particularly beholden to or particularly exposed to supply risk, for example, then a lot of organisations will seek to buy their supplier out. You buy the supplier out, you have an interest in their business, you can get some seats on the board, you can have an influence in how they produce and what they produce, some influence over the quality. You're reducing the risk that the inputs that you get will be of inferior quality. Okay? There's always a chance as well, I guess, that organisations will buy non-current assets or invest heavily in order to develop customer relationships, or in order to make sure the customer experience is just that bit better. Now, why would you do that? Well, you'd make sure the customer experience is just that bit better so they pay more or they come back, right? So it could be information systems, it could be technology, it could be other sorts of things to make the customer experience just that little bit better, to get them to tell people after they've dealt with you to bring them back. My point being that there are a number of reasons, a number of really heavy business-related reasons why organisations need to be really careful in managing their non-current assets. There's the sheer size of them too. So if you divide the total non-current assets into total assets, you will find that for most companies of a certain size, their non-current assets are a significant portion of their overall asset base. So take it as a given that non-current assets are pretty crucial for a firm. There's also increasingly this side reason, or I guess increasingly important reason, that organisations are buying particular assets. For what you might term to be social impact. We do a lot of work with organisations that are looking to try and invest for profit and try and buy assets, but buy assets that utilise clean energy technology, for example, or invest in a particular way that might utilise previously unemployed workforce, and therefore trying to address a social issue of unemployment or something like that. And the more organisations do that and generate a profit from it, the more information gets out and the more other organisations will do it, the more easily social issues get addressed. This one is a hot issue at the moment for many organisations. I'm going up to Canberra tomorrow to the Department of Foreign Affairs and Trade. How about that? You mentioned Canberra and the lights come on. You would have thought the lights would go off. No offence if you live in Canberra, right? And, you know, to work with a whole bunch of organisations to set up an impact investment fund that investors will buy into to try and address some of these things. It's really cool stuff. My point being that funds like this raise tens and tens of millions of dollars, sometimes hundreds of millions of dollars, for organisations seeking to generate financial return as well as be able to report multiple benefits, both to the organisation as well as to society and the environment, which is really cool. So, happy to talk to you more about that later on if you wish. What I want to do, though, is just drill down a little bit. Right? And drilling down a little bit by talking about property, plant and equipment as a core or a common component of non-current assets. So property, land and buildings, typically. Plant and equipment, anything, any sort of machinery, right? Cash registers, computers, office furniture, machinery, motor vehicles, etc., etc. Motor vehicles might even be carved out, might even be thought of as separately. So just to give us a little bit of context, a little bit of focus for the next hour and a half, we'll talk about property, plant and equipment, and then we'll sort of expand a little bit and talk about some intangibles as well. So, not wanting to get kind of too technical, so one consequence of having non-current assets is typically that they will expire over time. Right? We're not going to have them forever. There's only one asset that I can think of that doesn't expire over time or consider or get used up over time, and that's land. But I'll come back to that. But one general consequence of having non-current assets, and part of the reason why we need to manage them carefully, is that particularly assets like property, plant and equipment will expire. They will be used up. Right? So what we do with that, we need to be really careful about what we do with it. All right, so where do we start? So property, plant and equipment are initially recorded at cost, AASB 116, IFRS 16 as well, the international standard. Similar to how we've accounted for inventory, so the next few slides are basically what you know already. The amount of cash or cash equivalents that you have to give up in order to get a non-current asset. So the fair value of those cash equivalents. So, you know what? You give someone cash for a non-current asset, that's the cost that it's recorded at. You give them cash plus shares in your company, you go to the stock exchange or you go to the exchange of some sort, you get the market value of the shares, add them to the cash you paid, that's the value of the asset. So that idea here of cash equivalents is really only, relevant when you've got, the idea of fair value is really only relevant when you give some sort of non-cash consideration for the purchase of a non-current asset. Okay? So, you know what? The agreed value or the fair value of what you've given up in exchange for the non-current asset is what you record the asset at. No big deal. It's pretty consistent with what we've talked about so far. Also consistent with what we've talked about so far, the cost of an asset includes all costs you need to get it into your premises and in a condition fit for use. Could include installation, could include, well, obviously it's going to include purchase price, could include shipping costs, but insurance and things like that that are normal run-of-the-mill expenditures, not included. Okay? So things that are required to set up the asset and have it in a condition fit for use, a choice as to whether you insure it or not included. Okay? So I've got a couple of examples there. Right? Maybe right, the net removal cost of a warehouse and the land you've just bought, solicitors' fees, stamp duties. Without these, you don't buy the property. You don't get it. It's not going to be able to be accessible by you. All right? With land, not so much of an issue, but when it comes time to do, to work out the cost of a truck, the relevance of adding these things in is that $23,820 will be the depreciable amount that you then focus and calculate depreciation on. All right, so that's why this is relevant. Okay, so we're thinking about acquiring a non-current asset. There's a number of quantitative techniques that you would use in order to acquire them. So some of you guys are looking at, you're probably studying finance already. You will be looking at things like the internal rate of return, net profit, net present value, return on investments, etc. These are all different ways to evaluate potential non-current asset purchases, as well as social impact and things like that, as I've talked about. So just on that first one, just know, I'm happy to talk to you offline, but just on the first one, know things like net present value and internal rate of return take into account the the timing of the flow of cash in and out in relation to an acquisition. So, it's the use of a discount rate takes into account the time value of money. So the cash flows that you get later in a purchase become less important. And you're typically looking at things like if a net present value calculation is positive, then the asset might be in the accept, you put them in the potentially accept category. If it's negative, it's difficult to justify. If it's around about zero, then it could be, it's a possibility. Whereas the internal rate of return, you work out the discount rate that equates cash inflows and cash outflows and work out whether that is higher or less than your required discount or required rate of return in your organisation. Return on investment broadly refers to a calculation pretty similar to return on assets that we've already done. So what profit for the investment do you get divided by the investment dollars? Interestingly enough though, and I won't dwell on it for too much, but interestingly enough, a lot of organisations, a lot of executives, particularly some of the, some executives that are well entrenched in their views, will use payback period. So you're going to spend $1 million. How long will it take you to generate $1 million from that investment in order to pay it back? Okay? Now, on the one hand, you can think, well, it's not that sophisticated an approach given that cash flows that, because money loses value over time, cash flows that come in 2 years' time aren't the same as the same dollar as cash flows that come in today, because the money loses value over time. So if someone says, what's the payback period, and you go 5 years, well, then they're going to potentially evaluate another investment. And if the payback period is 3 years, then they're more likely to go with that one because it will be a shorter period for them to get their money back. But what it doesn't do is it doesn't take into account any cash flows that come after the payback period. All right, so if your payback period is 3 years and your cash flows 4, 5 and 6 years are really crappy, but if it doesn't take that into account. But if your payback period is 5 years and then 6, 7, 8, 9 year, ninth year is really strong, you still run the risk of not being able to accept the one, the later project because it's got a longer payback period. So just be careful. If you're ever in a position to evaluate capital investment or non-current asset purchases, just be careful about, be open to using a couple of different approaches. I, for example, would encourage you to think about using some approaches that at least incorporate the time value of money. But the finance guys will talk, will work through with you those sorts of things. If you're not doing finance and you want to learn more about this, send me an email or come and see me. We'll have a chat. Many companies also will choose to lease their assets rather than buy them. Okay, so we're going to touch on this a little bit when we talk about liabilities. But let me just kind of explore that just a little bit. So these calculations here help you figure out whether it's worthwhile to buy an asset or not. Okay? Assuming you want to acquire an asset, then it's also possible for you to lease it. So why would you do that? So what happens when you lease an asset is you rent it. You can rent it for a short period or a long period. A short period lease is generally classified as an operating lease. Right? So the payments you make under an operating lease, you debit lease expense, you credit cash. Job done. Under a finance lease, which is a bit longer, and there are some quantitative tests, but for our purposes, we don't need to dwell too much on those for now. But if we're going to take up a longer lease, So we're basically renting an asset, so an aeroplane or a building or something like that, and we're leasing it for a longer period, longer portion of the asset's useful life. Then we need to take it onto our books. So we need to debit asset and credit liability for the lease onto our books, even though we don't own it. It's kind of a bit weird, right? But remember the definition of an asset. Definition of an asset is if you control the asset, you don't have to own it. Right? And you think, well, that can't be bad. We're taking an asset and a liability onto our books. But if you think a bit more carefully, one of the risk ratios that we've looked at so far is what? Is debt to assets. So if you've got a debt to assets ratio and it's less than 1, which it should be, because your debts should be less than assets, right? Because assets equals liabilities plus equity. So debt or liabilities should be less than assets. Otherwise, we're in heaps of doo-doo. Okay? That's going to be less than 1. But if you add the same thing to the top and the bottom of the debt to assets ratio, it's going to go up if it's already less than 1, which it should be. So the point being that classifying a lease as a finance lease is a very difficult decision for an organisation, and one which many organisations will not want to do. Okay? Why? Because it makes them seem more risky. Because you're increasing debt and you're increasing assets at the same time. But at the same time, I just said the same thing twice. At the same time, there are a number of advantages for the lessee. You lease a car. Many people do it on a personal level. They lease a car, for example, through their work. Very, very effective way of doing it because you eliminate the risk of owning a car which becomes obsolete and conks out. Right? Why? Because every 4 or 5 years you get to turn your car over. Right? So for an organisation, you're leasing some technology, you're leasing some computer equipment, some IT, some sound equipment, whatever it is. You reduce the risk of obsolescence because at the end of the lease term, the lease company comes in, you renegotiate the lease, they replace the assets with brand new ones. Everyone likes brand new toys. There's little or no deposit. So you can actually get access to all of these assets and you don't have to put any money down. There's a tax advantage. The lessor gets a tax advantage and they might be able to pass it on to us. And under an operating lease, and I should have put under an operating lease here, you can actually use an asset and you don't have to buy it, you don't have to put it on the balance sheet if it's an operating lease. So if you think about it, you've got two organisations, otherwise identical, and they use the same assets, and one undertakes a finance lease and one undertakes an operating lease to acquire the same asset. The one that has the operating lease will seem to be less risky because their debt to assets ratio will be lower. Okay? So it is crucial to figure out how the asset purchases are being financed. Most airlines will, for example, lease their planes. So these are really big purchases or really big asset acquisitions that we're dealing with. Okay. So let's talk about depreciation. So I think, and this kind of gets to the crux of one part of the session that is kind of new. We've talked a little bit about it. Some of the mechanics of depreciation, I think it will be really simple for you guys, but I'm more inclined to focus on the choice and the implications of the choice. So let's have a go. So what is depreciation? Well, I want to talk about what it is and what it's not. What is it? It's a process of allocating the cost of an asset to expense as you use it. Carpet, lighting. Well, I don't know about depreciation because the lights go on and off, right? So they're pretty... Anyway, we won't comment because they're a bit variable, put it that way. Tables, computer equipment, technology, etc. These are all going to need replacing in due course. The roof was leaking a few weeks ago. All going to need replacing. Okay? Systematic allocation of the cost. Every time you use a non-current asset, you're using up a bit of the benefits in that asset before you need to replace it, upgrade it, undertake maintenance on it, etc. It's not current valuation. Anyone ever heard the saying, as soon as you buy a car, it depreciates as soon as you drive it off the lot? It's not true. What they're talking about is it declines in value as soon as you drive it off the lot. You drive it, you get in a brand new car, it feels lovely, right? You're assuming you're going to use it for 50 years or 25 years or whatever. You drive it off the lot, you're still going to be able to use it for 25 or 50 years. So depreciation hasn't changed. It's value that changes. Right? So the value depends on buyers and sellers and how badly you want to sell something and how badly people want to buy it. Depreciation depends on a whole bunch of assumptions we make and accounting records and accounting entries we record. Okay? Carrying amount, we've seen that already, cost less depreciation. Accumulated depreciation. So getting back to the point I was making before, what is the rationale for charging depreciation? We're charging depreciation on any non-current asset that wastes over time, that is used up over time. Okay? If you see an asset that is not used up over time, like land, no depreciation. Intangible assets are the same thing. So assets like rights and patents and things like that. If you have a patent for a certain amount of time, like a drug company, or a pharmaceutical company, then they will register a patent which is very useful and valuable for them, but it will only be for a certain period of time. Then other generic equivalent drugs come on board, the value of their intellectual property goes down, the patent expires, and they need to amortise it over time. Okay? So there's a bunch of reasons why we need to charge depreciation. Depends on how we use the asset, depends on wear and tear, useful life, all that kind of thing, right? So how do we do it? We're going to need 3 bits of information, right? Cost, useful life, residual value. Now, you think about it. We can, I get paid for standing up. I do get paid, right? A little bit, but not much. I get paid for standing up here and saying to you that depreciation is an economically significant, necessary expense. And it is. Think about the estimates and judgments that go into this figure, though. We need to figure out what the cost of an asset is. Now, most of us would be able to get around about the same number given the same set of data. Useful life, though. How long do we expect to use our car or a bit of machinery? If you say 10 years, awesome. You say 20 years, fabulous. Some of you might say 8 years. I'll give you an example. So Time Warner, the US telco, 2017, chose to extend the useful life of their non-current assets from 15 to 20 years. No big deal. Wait on. All of a sudden, what are they doing? They are stretching the depreciation over a longer period of time, meant $20 million per year of reduced expenses. All of a sudden, the profit goes up by $20 million a year just because they extended the useful life of their non-current assets. Okay, so all of a sudden you're writing off the same costs, but you're writing it off over that period of time instead of that period of time. And if you're being held accountable for meeting quarterly earnings benchmarks, all of a sudden you meet them. So again, it was fully disclosed in the financial statements, but it's worth, if once you guys get to a point where you can figure out if profit has gone up because an entity has changed its accounting policy or because they're operating more effectively, then you're more sophisticated in using financial statements than what you were when you walked in the door at the start of the semester. And one of the key objectives for this subject, tick. Also residual value. How much do we think we're going to get from the asset at the end of its useful life? Things like computers and cars, not so hard. But once you get to specialised assets, it's a lot more difficult. All right, let's get into it. So let's set up an example, fairly simple example. I keep on having to look at, some of you in my workshops will know this already, but I keep on having to look at the clock here because my watch is totally dead and I have no idea what the time is. So And this clock, unlike the clocks in some of the workshop rooms, is accurate-ish. Okay. So, simple example, I want to show you three different methods. Straight line method, diminishing balance or reducing balance method, and the units of production or units of use. Okay, and I'm just going to talk to you about how to put the methods together, the sorts of things to consider, and I'll leave you to look at the, the number crunching yourself. All right, so we've got a delivery truck. It sounds like a pretty ordinary truck, right? It's $13,000. We think at the end of its 5-year useful life, it's going to be worth about $1,000. Okay? And throughout the life, we're going to travel about 100,000 Ks, which is kind of about right. Maybe for a delivery truck, we'd expect a bit more, but hey. All right, so the first one, and this is the one that we've been using all the time up until now. So straight line depreciation expense is the same each year. So a little bit circle that one. We assume that the benefits consumed of the asset will be the same each year, regardless of how much it is used. So the asset will expire over time. Okay? Cost minus residual over the useful life. And if you think about it, it kind of makes sense. Cost is $13,000, and we think it's going to be worth $1,000 at the end. So therefore, $12,000 of the value is going to expire over 5 years. That's how you think about it. So that's the depreciable amount there. That's the amount by which it's going to depreciate. And if it expires over 5 years, that means $2,400 per year. So then, you can set up an Excel spreadsheet or something really simple like this, and away we go. Uh-oh, was that a coffee? Oh, whoops. Sorry, I'm not laughing. Okay? Well, it wasn't hot, was it? Was it? Okay? All right. So depreciable amount stays the same, and I'll draw your attention to that. I haven't got any tissues, yeah. Sorry, it's gone everywhere. The depreciable amount stays the same. I draw your attention to that because that's a point of difference with regards to one of the other methods. Okay, the rate is 20%, 5-year period. Depreciation is the same, and then we can get the accumulated depreciation and the carrying amount each year. So basically, the cost. So we've got accumulated depreciation 2,400, carrying amount 10,600. That's the cost less accumulated depreciation, not the depreciable amount. You depreciate it down to the scrap value. They're the amounts we pick up in the balance sheet in the accumulated depreciation each year. They're the amounts we pick up in the P&L. All right, so far. Entry each year. The diminishing balance, though, is a little different. Now, don't stress about the method. N in this one, N is the useful life, which is 5. R is the residual, and C is the cost. So in this case, N is 5, R is 1,000, and C is 13,000. We will either give you the rate, we will give you the rate if you need it in the exam. Just know, though, that as a general rule, the diminishing balance or reducing balance rate will be about twice the straight line rate. Okay, straight line rate 20, diminishing balance or reducing balance 40. Now, here's the point of difference. So in each case, 40% is applied to the carrying amount of the asset. Starts off 13,000 multiplied by 40 gives you 5,200, gives you a carrying amount of 7,800. That goes to the starting value of the carrying amount for the following year. Then you multiply 40% of that to get your depreciation for the following year. So it's fundamentally, the essence of this method is different to the straight line method. So you're writing down the reduced balance each year. See how the depreciation expense is higher at the start and lower at the end? Because you're taking 40% of an increasingly reducing figure. I think that makes sense, increasingly reducing figure. Right? The base figure for your calculation is getting smaller, therefore your 40% gets smaller as well. This one is a rounded figure to make sure you get down to the 1,000, because it's not going to be perfect because it's a rounded number. Okay? The other units of production or units of use method, it makes a different assumption again, or is based on a different assumption again. And the assumption is that the more you use the asset, the more depreciation you should charge. And from something like a motor vehicle, this kind of makes sense. Aeroplanes kind of make sense. I don't know if there's any aeronautical engineers here. No? Okay, I can speak freely. No, all I was going to say is the aeroplane maintenance program for aeroplanes is based really strictly on the number of hours they travel. Right? So once they get into a particular phase of travel, time to have certain maintenance, maintenance works done, etc., etc. In a case like that, it would seem to kind of fit if they at least thought about using the units of production or units of use. So you work out, so the cost and the residual value are the same, but the useful life is determined, is designated in units. How many units do you think you'll travel? And in this case, we're told, maybe by previous experience or whatever, or we're going to turn the delivery truck over when we get to 100,000 Ks. So you work out the cost per K or cost per unit, and then you just work out the yearly units you do. So in this case, for example, we've got the depreciable amount is 12,000. We're told that we're going to do 100,000 Ks over the useful life of the truck. So therefore, and that should, instead of unit, I really should have put kilometre, right? So for every kilometre we do, we're going to charge 12 cents depreciation. So then, if we chose, if we travel 15,000 kilometres in a particular year, depreciation is 1,800. So then, I totally made these figures up, right? So you can just, there's no way that you could have got those. We just totally made them up to give you a point of reference. So if, for example, in 2013 we travelled 30,000, you multiply that by 12 cents, depreciation 3,600, there gives you carrying amount, and you go from there. So under the units of production, it's going to vary a little bit, but the fundamental assumption is that the depreciation charge is based on how much you use the asset, which kind of makes sense. So drawing all that together, so straight line, reducing balance of units of production give you a completely different profile of the depreciation. It's more visible when you look at the patterns of depreciation over time. So diminishing or reducing balance approaches zero, straight line, and the units of production will be all over the place where our usage is not uniform. Okay? So what? Well, companies can choose which method to apply. There used to be a whole lot more funky kind of choices, the inverse sum of the digits and sum of the digits methods and all that, which was just earnings management city for a lot of organisations. You could pick the depreciation method that gave you the result you wanted. And that kind of goes against this idea of producing information that's useful for decisions and comparable. So, the basic kind of decision tree is if it's practical and you've got enough data, then the most accurate method to use is the units of production. Right? Otherwise, a fairly safe assumption after that is the straight line method. If there's a compelling reason for using the reducing balance or the diminishing balance, use that. But you wonder about how and to what extent or what categories of asset that might be most useful. And I can't naturally think of one as easily as you could maybe in respect of the units of production or the straight line method. So straight line method's probably safest. If you've got more data, use the units of production. Diminishing balance probably third choice, put it that way. Either way though, organisations will need to, when they change their method, they'll need to identify the change, they'll need to explain the impact of the change and things like that. Rest assured, regardless of how much people will seek to justify it for you, this is a fundamentally subjective calculation that materially affects depreciation. Hence why a lot of bankers, have we got any bankers in the audience? All right, so there's a couple. A couple have sort of gone like that, didn't want to reveal themselves. That's okay, you're among friends. So that's why a lot of bankers will actually look at earnings before depreciation charges. So they'll look at EBITDA, so earnings before interest, tax, depreciation and amortisation, because what they're looking to do is get the most objective measure of profit without being affected by choices inherent in the depreciation or amortisation calculations. Okay, so when we've got I've got a lot of colleagues in my department, for example, that do a lot of research on earnings management. So the choices that the choices that companies make to try and make their profits look as good as they possibly can. And a lot of the results that get uncovered are uncovered by looking at the choices of depreciation method and how organisations sort of choose methods and how they choose useful lives and things like that. All right, so we might do 5 more minutes and then we might have a 5-minute break and then we'll make a rush to about 7 o'clock and then we're done. Okay? Maybe 5 to 7. Okay. Another part I wanted to really sort of explore with you, which I think which is pretty crucial in this topic, is what happens once you've got an asset. So you've got an asset, and you need to spend more money on it. Right? Depends on how do you classify that extra spending. Right? So you need to update it, you need to maintain it, you spend some more money on it. How do you think about what you're spending and how do you think about how to classify it? A distinction we need to make in accounting is between a revenue expenditure or a capital expenditure. So whether or not you debit the asset or whether or not you debit an expense in respect of expenditure you make about an asset. So you get the building painted, for example. Asset, expense. You redo the air conditioning system. Asset, expense. You upgrade the engine in your whole fleet of delivery trucks. Asset, expense. Now, one-off, no big deal. But when you're talking about hundreds of trucks or when you're talking about huge buildings, it can be a big deal because it'll affect assets if you increase assets. It won't affect profit, so therefore some of your debt to equity rate or your debt to assets ratio looks better. There's no adverse impact on profit, so your profit looks better. Return on equity looks better. Return on assets might, because assets go up as well, so assets go up, returns not affected, so that might sort of flatten out a little bit. But there's fundamental impacts on some of your ratios depending on how you treat expenditure like this. Anyone remember the Enron collapse? Enron? WorldCom? Anyway, look them up. Huge company collapses around the start of the 2000s. Huge, up until that time, some of the largest collapses in history, made more difficult to identify, at least in part, because these organisations made choices to carry forward or capitalise expenditures rather than expense them. Made the assets look stronger, profit look higher than what it really should have been. It enabled them to continue to operate and incur more debts, make it more difficult for them to trade out, and they didn't trade out in the end. Okay, so a key test that we use is whether or not the expense is a recurring nature. Is it more, or is it likely to extend or simply preserve the asset's useful life? Whenever you've got a situation where the expenditure is likely to extend the productive capacity or extend the useful life, capitalise the asset, debit to asset. Okay, it's a general rule. So ordinary repairs and maintenance maintains normal operating condition, doesn't necessarily increase productivity, debit expense. Where you've got an addition, increases productivity, may extend the useful life, maybe an improvement or an expansion, debit the asset. All right? So if you're given a situation like this in the upcoming exam, go forward and apply notions like this. Go back to the definition of an asset is their future benefits. The future benefits in this case refer to the expansion or extension of the useful life or the productivity of the asset. And we call it a revenue expenditure, but don't let that confuse you. This is your more ongoing expense. This is your more, extending the useful life of the asset. Where that happens, the expense is not recognised straight away. Instead, we recognise the asset, we debit the asset. Current income will be higher because we haven't recognised an expense, and current taxes will be higher because profit's higher. Revenue expenditure, your income, so you debit an expense. Expense is recognised in the current period. Both income and taxes will be lower. This is a significant choice to make. Right? This is the same sort of decision sort of confronting organisations when they make major investments in, like, sponsorships, of an F1 team or a major advertising campaign, where many organisations will spend tens and tens of millions of dollars on an advertising campaign, particularly if they do things like buy an advertisement in half-time at the Super Bowl each year. Right? They are significant investments. If you debit the asset instead of debiting expense, think about what happens to each of your ratios. All right. What do you think? We take 5 minutes. 5 minutes? All right, I make it 6:05. I'm going to start again at just after 10 past, and then we'll just plough on. Okay? Okay. So just to reiterate, guys, I might not have spelled this out clearly enough. Rest assured, I will make a time available. I've got to chat with some of the tutors. I will make a time available in the coming weeks. As soon as we can, there will be a couple of hours where you guys can come in. As you walk in, we'll give you your test. We'll give you the solution. You can sit there and you can review it. Okay? You get a feel for where you went wrong. Everybody's happy. We can't publish the actual results. Well, we publish the results by way of your ID number. We're not going to send out the marked solution. You can have a look at it when you come in. Okay? So hopefully that will allay your concerns if you have any. All right? I've also had a couple of good questions about, there was, have we covered enough material in the test? Have we covered enough material in the lead up, in the topics in the lead up? We've reviewed the. You may have realised already that there are a number of questions that were very, very similar. If not, on occasion, there was at least 4 or 5 that were the same as questions on Wiley Plus in earlier weeks. That is, and that's fine because we give you enough information. We give you a certain body of information, and we say things like, here's your body of information. If you know what's in here, there will be a reward for you. Okay? So please don't harbour any kind of uncertainty as to whether or not you did have enough exposure to enough information to do well on the test. All right? I'm quite happy to chat to you offline to go through with you where there might have been a lack of understanding or a misread of a question. Not a problem. Know as well that the mark that you see on the LMS is out of 30. This is reduced to a mark out of 15. So if you're talking about 2 out of 30, it is 1 out of 15, and therefore 1 out of 100 that we're talking about. Okay? There is enough checks and balances in this subject that it is my job to make sure that the results are completely fair for you. And that is what I do. All right? So please don't be concerned. Come and look at your test. You are welcome to do it. But just give me a few days to organise a day and I will do it. Okay? Thank you. So, what else can we say? Well, one of the things that we need to be able to do when we're accounting for non-current assets is to go through and consider the ongoing valuation of them. So, as I'll talk to you in a minute about, There's two basic ways of accounting for the ongoing valuation of an asset. Either we start off at cost and we periodically review the value of the asset through impairment losses and the like, or we adopt a fair value model and we review it regularly. Okay? So, generalising, on balance, most organisations will go for the cost and impairment model. So cost, depreciation, impairment, the odd revaluation is the general way that most organisations will approach this. So let me sort of unpack that a little bit. So we've got an asset, we're motoring along, we're depreciating it, we're reporting it as we know how to do so far. Occasionally things happen, and as tragic as it is, you know, the example of the natural disaster in the last few weeks in New South Wales and Queensland is a common occurrence that will mean that the value of some assets for some organisations will decrease. And so what do? We record, for accounting, an impairment loss. Why do we do that? Is the balance, remember the balance sheet, the role of the balance sheet is to try and communicate the financial value of the assets and resources of the business. And if something significant happens that impacts on the value of the assets that we have, we recognise an impairment loss. It's the amount by which the carrying amount of the asset exceeds its recoverable amount. Right? The carrying amount of the asset exceeds its recoverable amount. If the value of your motor car has gone down to $5,000 and you've currently got it listed in your balance sheet at $20,000, you need to recognise a reduction in the value of 15, and you call it an impairment loss. Okay? There's a little bit about how to work out the recoverable amount, but the idea is what are you carrying it for? What can you recover from it? Okay? The recoverable amount test, calculate the fair value, what you would sell it for, calculate the ongoing value in use, you pick the higher one, and that's the base that you compare it to. Right? So you only need to recognise an impairment loss where it is identifiable that the recoverable amount is lower than what you've got it currently listed at. And it's generally triggered by some sort of significant event. It is helpful. It is absolute. Well, I'll even go so far as to say it's crucial for when you are looking at a balance sheet of an organisation that you are perhaps thinking about dealing with, that you review their approach to asset valuations. If their asset valuations are based on cost, if they take into account impairments, or if they don't take into account impairments, if they've got, you know, banana plantations in the New South Wales coast, for example, I don't even know if they grow bananas in the New South Wales coast. But if they do, and they haven't taken an impairment loss in recent, you know, or if they're not going to take an impairment loss for the period that they've just encountered, then, you know, you need specific information about why, because a lot of properties did, and a lot of properties will need to. So in a case like this, really simple example, just to highlight what we're talking about. So if you've got a case that the net selling price of an asset is $18,000 and the value in use is $16,000, and if, you know, and we're just picking figures here, but if we were carrying the asset at $25,000, then the recoverable amount is 18, so it's the higher of the two, and you need to write the asset down by 7. So debit impairment loss goes straight to the P&L, straight as a loss in the profit and loss statement, and credit accumulated impairment loss computers. So you'd have computers, and this is an example in the text, so you'd have the computer at cost, less accumulated depreciation, less accumulated amortisation. So you'd have the two things running together. Okay? As the balance sheet gets a little bit more complex, let's say you've got accumulated depreciation of 7 and accumulated impairment loss of 7, you just have asset less accumulated depreciation and amortisation 14. Like, so you'd lump them together for the purpose of the balance sheet presentation. Okay? So I guess the key message is an impairment. So depreciation arises where you've got this ongoing using up of an asset. Impairment loss will happen if some sort of significant event occurs which materially affects the value of the asset. Okay. The other approach, or I guess the opposite to impairment, is the possibility that assets get revalued upwards. Right? If there is an across-the-board assessment of the asset of the value of your assets, and you conclude that there is, you get an independent valuer in, etc., then it's possible that your assets also might be revalued upwards. Right? So there's a couple of procedures to go through when you revalue upwards. So bear in mind, again, what we're doing is we are, we're applying the cost method of recording our assets. We're depreciating, and if something happens periodically that we have to revalue downwards or upwards, we're doing it. Okay, but we're starting off with cost. So let's assume, let's say something happens. Markets go up. We get a property valuation. Something's gone through the roof. We've got a gold mine, and the neighbouring properties just drilled down, and they've just found gold in the neighbouring property. So there's a reasonable chance that we've found it as well. All right. So there's compelling evidence. What do we do? 3 steps. Record depreciation to the date of the revaluation, transfer it to the accumulated depreciation account, record the revaluation. We've got equipment with a fair value of $45,000. Equipment was originally purchased for $75 and has a book value of $50. Okay, so what do we do? A couple of things to do first. All right. So the book value, so we've charged $25,000 depreciation so far. We purchased it for $25 and it had a carrying or book value of $50. Write the accumulated depreciation off against the asset. So you're transferring it back to the asset. And it's the carrying value of the asset that you're actually that you're actually revaluing. Right? That brings the asset down to a book value of $50. And the revaluation expense of $5,000 can be recorded then. Okay? If subsequently, and here this is where it becomes a little tricky, if subsequently you revalue something downwards and then you revalue it upwards later on. So something happened, in this case, for example, we've got a parcel of land. And the parcel of land initially gets revalued upwards by 50, and then it has to be subsequently revalued downwards by 80. Okay? So we revalue it upwards by 50, and that has to come downwards by 80. All right, so let's unpack it just a little bit. When you revalue an asset upwards, you do 2 things. You debit the asset, because it's revalued upwards, and you credit an account called revaluation surplus, so it becomes a part of equity. It doesn't go through revenue or gains. Whereas, if you revalue an asset downwards, like we just did then, that does go through expense. So it's lopsided. You revalue it downwards, it goes through expense. You revalue it upwards, it gets adjusted against equity. Why? Accounting standard setters want us to be conservative with how we recognise asset valuations. Okay. The complicating factor, though, is if you revalue an asset one way and then you reverse the revaluation, you need to reverse the initial effect. So if, and I can't write on this, which is annoying me, but if our initial entry was debit the asset, credit revaluation surplus for 50, then subsequently we need to reverse it downwards by 80. You need to reverse the original 50, and then you debit revaluation expense and credit land for the balance. Okay? So think about this. This is about as complex as it gets, right? So think about this as doing 2 things. One, reversing the original revaluation upwards by 50. So it's gone up by 50, now it's got to come back down. So you revalued it upwards, you're reversing that bit to bring it back to where it was, and then you're taking it down another 30. Okay? Why does that? again, accounting standard setters require us to account for expenses we think are going to happen, but revenues only when we know they're going to happen. And I guess the other part of this is that accounting standard setters are trying to avoid the option that CEOs and entrepreneurs are simply going to choose to revalue assets upwards and recognise gains in current period profit and loss statements, which would tend to mislead users of those statements. All right, so that's the first approach. There's also another approach that organisations can tend to use, and that is to maintain their assets at fair value right from the start. So periodically revalue every 2 to 3 years. The situation I was just talking about, we start off with cost, we depreciate, something significant happens to increase the value, we recognise it, something significant happens to decrease the value, we recognise it. Other than that, we recognise cost, less accumulated depreciation, that's how we account. Some organisations you'll also see recording their assets at fair value. So far more frequent revaluations upwards and downwards. So you might see something like property, plant and equipment at director's valuation or at independent valuation. Right? So that is an attempt by them to maintain as best as possible the current valuation in the financial statements, where the previous approach that I was just talking about, cost, less accumulated depreciation, and we adjust for significant things that materially change the balance. So they're variations of the same approach, right? And I guess if you're an entrepreneur, if you're a business owner, what would drive your choice? Probably one of the things that would drive your choice is the extent to which your assets are likely to grow over time, grow in value over time. If they're significantly risky, and they might go up or they might go down, maybe you're better off using the first approach, which is a little bit more stable. Probably, you can avoid the investment you need to regularly revalue them up or down, avoid the kind of significant fluctuations which tend to spark a bit of uncertainty in the minds of users. What else? So I guess one of the other semi-technical things that is worth mentioning is what happens when we dispose of property, plant and equipment. So we can sell them, we can scrap them, or we can exchange them. And I guess the one that is most, technical for us to look at is the sale. So again, a fairly simple example, fairly simple data that just gives us enough information to kind of walk you through the process. So in this case, we've got a gain on sale, right? So we've got office furniture, we sell it for $16,000. Original cost was $60 and accumulated depreciation is $41. So 60 minus 41 gives you $19,000 written down value at the start of the period. What we haven't done though is depreciation for the first 6 months of the current year. So the first 6 months of the current year is $8,000, which we haven't recorded yet. So which would bring the accumulated depreciation up to 49, carrying value of the asset 11, proceeds from sale 16. So there's the difference straight away. All right, so first step, calculate depreciation up to the point of sale. So record the additional depreciation, $8,000. So what does that mean? That means the cost of furniture is $60,000. Accumulated depreciation 41 to the date at the start of the year, plus $8,000 to the current year, to the date of sale, gives you the carrying amount at the point of disposal of $11,000. All right? So the asset in our books is effectively worth $11,000, or we think there's $11,000 of benefit in the asset at the point of sale. We get $16,000 for it, therefore we've got a gain of 5. How does that look? So the main role that we've got in recording the sale is, at the moment, we've got cost of office furniture, accumulated depreciation is the main accounts open in respect to that asset. And if we sell that asset, those are the accounts that we've got to reduce to 0. Okay? So what do we know? So debit cash, $16,000. You want to reduce to zero the accumulated depreciation account, and if that's got a credit balance of 49, then that needs to be debited. You want to reduce to zero the asset of the office furniture cost account. That's got a balance of $60,000, the cost of the asset. Now, you may have also, another way of doing that is if you close the accumulated depreciation off against that, the balance is $11,000 and you can credit that $11,000. Either way, debits are $5,000 more than credits so far, and the remaining amount is a gain on disposal of $5,000. So this cash inflow here will go in the investing activities section of the cash flow statement. This gain on disposal here will go in the profit and loss statement. Right? So a lot of organisations will put that below, right at the bottom or just under gross profit. It doesn't really, for our purpose, we don't really care where it goes. As long as it comes out of gross profit. Don't put it in gross profit. That's it. Varying that a little bit, how would it look if it was a loss? Assume the office furniture was sold for $9,000 instead of $16,000. And if it was sold for $9,000, then it's going to be $7,000 the other way, right? So cost is obviously the same, accumulated depreciation is the same, carrying amount at date of disposal, all the same, all the same. Proceeds from sale, different. Proceeds from sale, $9,000. Proceeds are less than the carrying amount, therefore we got a loss of $2,000. How do we record the loss? Again, same thing. Cash, debit, cash, $9,000. Accumulated depreciation, $49,000. We need to cancel that. We also know that we've got an office furniture account that we need to cancel out, so we credit that. What's missing? There'll be a missing amount on the debit side. There'll be a gap on the debit side of $2,000, a loss on sale of $2,000. Again, cash inflow, loss on disposal goes to the profit and loss account. Okay? This gets a little bit more tricky in a couple of weeks where we have to derive the cash flow statement, and there's a loss, gain or loss on sale, and there probably will be a question or two on the exam on gains or loss on sale, and you work out the cash flow resulting from those, but I'll show you how to do them. Okay? All right. So one of the only things we haven't talked about is intangible assets. And for some organisations, ironically, for some organisations, intangible assets are huge. I mean, Coca-Cola Amatil is an example of an organisation that's got far and away its largest asset as an intangible asset. Bottling rights. So the rights that they have to make the little black liquid, have the right to put the little black liquid in those little red tins and call it Coca-Cola is far and away their most valuable asset. Why? Because if you like that, you're going to buy it no matter who makes it and things like that, because you know the brand. Right? And they have the rights to do it in Australia, for example. And so their asset, their largest asset, is that right, because that's a key source of future revenue for them. Okay? So typically when you're talking about intangible assets, you make a difference, you make a sort of a distinction between identifiable and unidentifiable intangibles. Key difference being if you can separate and sell the intangible asset. So let me take the first one, for example, a patent. So, some days when you go into the pharmacy and you ask for a particular prescription medication, and the doctor will say, the pharmacist might say, oh, there's a generic equivalent. All right, so the prescription medication that the doctor prescribes for you might be $50, generic equivalent $6 or $8. Okay, part of the reason that might have occurred is that the patent on that exclusive rights to make that drug might have expired. Right, so having a patent, having a sole right to be able to make that product is a source of significant value for the pharmaceutical company, but they only get it for a certain period of time. So, but what you can do is you can sell a patent. It's definable. It's identifiable. a copyright. So I have the rights to broadcast the AFL Grand Final or the F1 Grand Prix or the TV Week Logie Awards or something like it's an identifiable right that you can sell. You compare that, or Nike. Imagine if you had the rights to be able to put the Nike swoosh, doesn't matter. You know, the little tick, right? If you had the rights to put that on the shoes that you could make in your garage, all of a sudden they'd go from worth nothing, no offence, to worth a lot of money because people know what the Nike symbol means, right? It is a source of incredible value. On the conservation side, you know, if you buy a jumper, you see a lot of people, and again, it's a bit odd, but if you hang around the clothing stores and you see, you know, wool and gums, a lot of people will look for the Australian Wool Corporation symbol on it because it signals certain things. Identifiable trade names, brand names, licenses, etc. are crucial sources of value. Okay. Unidentified, distinguish those from goodwill. So if I go and buy, you know, if I go and buy a company, we go and buy, let's go and buy a company, right? So we might say we're going to go and buy Deakin University. Oh, is that bad? No, we'll go and buy the restaurant across the road. Let's do that. Okay? We're going to go and buy it's gone. Let's go and buy the coffee shop in the corner. Okay? Coffee shop in the corner. That's a better example. The restaurant did anyone go that one in the garage? Did anyone used to go in that? It was great. Anyway, it's gone. Doesn't matter. I digress. So we're going to go to the coffee shop down the corner. So we go along and we say, all right, let's value your machinery and your stock and your tables and chairs and TV and premises. And it comes to $300,000 for argument's sake. Then we might negotiate and we end up paying them $500,000. So what are we paying for? We're paying for the fact that if we own it or they own it, people that come in for their coffee tomorrow are going to come in. They're not only coming in because the previous people owned it, they're coming in because that store has a good name. The store is known to make good coffees or good smoothies. That's why when restaurants like that change hands, you typically keep your barista and you keep your chef because they're the source of significant goodwill, right? But what happens though is if we're going to purchase it and we've got a balance sheet, we put in fixtures and fittings and assets $300,000, goodwill $200,000 because that's what we paid. Okay, but we can't take goodwill and say, here you go, do you want to buy goodwill? Right? It's silly. Okay, and yet sometimes I sort of introduce that a different way, and if I say, well, okay, let me role play. I'm coming to you for a loan. You're a bank. I'm coming to you for a loan. And I say, well, I need $1 million. Actually, I need $800,000 loan, and I've got $1 million in assets, and I've got no debt. No debt. Now, without knowing any more, would you lend me the money? Yes or no? I've got $1 million in assets and no debt. All I want is $800,000. Come on. Right? Generally, the answer is yes, right? So most banks will lend you 80% of an asset, notwithstanding, and if you've got no debt, they will love you as a customer, assuming my debt service capacity is okay. All right? What about if I said to you, I'll give you more information about my assets, that there's 990,000 of it was goodwill? Right? Now, it's a silly example, but so goodwill is intuitively a different category of asset than maybe a patent or a brand. Because if I said I've got $990,000 in a patent, and you're going to go, well, what is it? Well, I'm the only one in Australia that can bottle and make Coca-Cola. You're going to go, you're kidding me? Have the money. Right? So that's where they kind of differ. So, if you're ever looking at things like an exclusive rights to bring a business into Australia, that's a serious source of money right there, assuming the business is any good. So that's the general, it's a bit of storytelling, but that's the general way in which identifiable and unidentifiable assets can be conceptualised. The implication being that you account for them differently. So if you've got an identifiable asset, typically it will expire over time and you need to amortise it. If you've got an unidentifiable asset like goodwill, then you need to, it's subject to an impairment test like the other types of assets. So I took a little bit of time to build that distinction up because it means a difference when you come to account for it. All right? Typically amortisation, for example, so typically patents, for example, will be amortised over a certain period of time, 4 years, 6 years, 3 years, 5 years, whatever. Interestingly, Coca-Cola, for example, it's a constant source of argy-barl back and forward with the auditors. Coca-Cola Amatil do not amortise their bottling agreements. All right? They've got an agreement with the Coca-Cola company to bottle Coca-Cola. They don't amortise it. If they did amortise it, their profit would go through the floor. However, their argument is, and it's stood the test of time so far, that they are so assured, so certain of getting that bottling agreement rolled over and over and over that it's essentially not expiring. Yeah. Interesting situation. And then amortisation, you can think of amortisation as simply a sort of an intangible asset variation of the depreciation calculation. Debit amortisation expense and credit accumulated amortisation. Couple of bits and pieces. How are non-current assets reported? What methods are used? Typically, key distinctions under non-current assets: property, plant and equipment, and intangibles. Intangibles might be separated into identifiable and unidentifiable. Typically, goodwill and patents or brand names or mastheads, etc. There's also, I would encourage you, if you're ever in a position, you have a look at the notes, figure out things like approaches to depreciation, useful life. You'll be able to figure out what the useful lives of the assets are. But most of the disclosures will look fairly standard. Is this a significant area? Yeah, you bet. So let me talk to you about a couple of examples, and then I'll show you a couple of ratios, and then we're done. Okay? So far, I've sort of skirted around a little bit what the extent of judgment and the implications of that judgment are in accounting for non-current assets. But let me give you a couple of examples. So WorldCom, when it collapsed in the mid-2000s, was the largest on record company collapse. Part of the reason for the company collapse is that they had classified what was essentially maintenance costs on their service. They're a telco, right? Essentially maintenance costs on their service lines to the extent of, there's no error there, $3.9 billion. Debit asset, credit cash, not debit expense. Think about the impact on profit. So profit is $3.9 billion higher than it should have been. Assets $3.9 billion higher than it should have been. They should have been as well. All right. When you look at a balance sheet, right? The fundamental essence of a balance sheet is the number next to the assets column in the balance sheet should be what that company has in value invested in those resources. If you've got a number next to your assets that you can't reap any benefit from in the future, it shouldn't be there. AOL, another technology company, capitalised their marketing costs. I haven't got the figure here. It's the low hundreds of millions of dollars. OneTel was an Australian company. So years ago, and I've got a couple of videos that we'll look at them later on in the semester. Once we've sort of got enough, we've covered enough ground so you can appreciate all the issues. Everyone know the Packers, so James Packer and the Murdochs, Lachlan Murdoch. So they came together and they tipped money into a company, and it was called OneTel. It wasn't run by them, but it was run by one of their friends. So OneTel sat between the customer, so us, and the telco. Okay, so OneTel had the great idea of going up against or competing with Telstra and Optus. Okay. And there's all sorts of funky stuff going on with OneTel, and you know, I wouldn't do it justice if I tried to explain it to you, and it's 6:45, so I don't think you'd want me to explain it because it'd take too long. Suffice to say that OneTel ended up capitalising, they bought a licence, a spectrum licence, to be able to emit telecommunications in several states in the southeastern corner of Australia. That's okay. What they didn't bargain on was that they then had to go back to the telcos, Telstra and Optus, to rent the actual pipes underground to enable them to use their licences. And of course the other ones, you're not going to go, yeah, sure, competitor, yeah, sure, you can rent our stuff. So they charged them an arm and a leg, and it became too expensive, right? So all of a sudden they spent $500 million on spectrum licences that they couldn't use. Whoopsies, right? $500 million of an asset sitting in the assets column that was worth zero, baby. Zero. And this was a company that within 6 months, people have gone from, yeah, this is a buy, this is one of the fastest growing companies in the world, to this is worth nothing. Very confronting, very famous collapse. 2 more examples. I like this stuff. I hope you're enjoying a few anecdotes. HIH FAI. If you ever want a tragic story. I was going to say funny. It's a poor word. Tragic story, right? Knowing what we know in account, we've only been together for 7 weeks, right? HIH purchased FAI. FAI Insurance. You may have heard of them. HIH. The purchase price was $300 million, and you bet, look at it, that accounted to $25 million in hardcore assets like property, plant and equipment and machinery and actual physical inventory and things like that. $275 million in goodwill. Doesn't work. So debit goodwill, 275, debit assets, 25, credit cash. Ooh. You'd think that the risk, like red flag, right? So as auditors, we come along and we look at this company, and they make a purchase, or you do some due diligence on that purchase. I'm going to buy something worth $300 million, and I'm going to recognise $275 million. And it'd want to be really good, really big upside. You don't see that very often, unless you're buying something like a technology company that's just about to discover something that's going to revolutionise the world. Okay. And again, that Time Warner example of lengthening their depreciation periods, AOL did it with their amortisation, but Time Warner, it meant an increase to quarterly earnings of $19.6 million. So the big dollars that these companies are playing with, and they're made possible by the decisions in and around non-current assets. So, I'll keep bringing in some examples for you. They are everywhere, where companies are using the discretion, because again, right, and rightly so, it's like you guys reporting on your own performance. Some of you guys are going to come up to me and go, I got 28 out of 30 on the test, and you must have made a mistake in marking because I reckon I got 30. Right? And that's completely rational. And companies are exactly the same. They're reporting on their own performance, and they are looking to portray their performance in the best possible light. Anyway, I could go on, but I won't. So how do we figure out whether companies are managing their non-current assets? Well, there's probably 3 things I want to share with you. One will give you, and these are average calculations, right? So there's laws of large numbers, there's a little bit going on here, but think about the kind of intuition behind this. So if you take the average cost of property, plant and equipment, you divide it by depreciation expense. What are you doing? So what you're doing is you're giving a bit of a sense as to how long or what the asset profile of your company is. So, average asset 66 and 70, you divide by depreciation, it gives you about 9.1. So in 9.1 years, you would have depreciated your whole asset base. That's kind of what, how you can interpret that. Gives you a bit of a sense as to, if you get a number of companies in the same industry and one is completely out of step with the others, it might suggest to you that something's not right with that company. All right? Whether it's 9 or 10 or, whatever. What you don't want to see, though, is, companies going, 8, 9, 10, etc., and one company being 35. That would suggest, for example, that their depreciation, either their asset profile is significantly different to the others, or their depreciation calculation is a lot lower than the others, which is probably the main danger. A variation of that, accumulated depreciation divided by depreciation expense, average age of property, plant and equipment. That's a slight variation. The one The one I'll refer you to, though, that can go both ways is the asset turnover. Now, we're talking about asset turnover. We haven't done it in detail, but we're talking about asset turnover in one of the questions in the workshops this week. Now, I don't know how far you'll get in your workshops this week, but I've put a question up to do with ratio analysis. It's more a case of we'll sow the seeds in the workshop and get you guys to look at it offline. But one of the benefits, I guess, that I referred to earlier in the session tonight of getting non-current assets is that you get them, you create infrastructure, they eventually generate more activity for you. In other words, more sales, right? So net sales divided by average total assets. So in theory, the more assets you've got, once they get embedded, once you start utilising them, the more activity you can generate. What you don't want to see, what you don't want to see though is you don't want to judge too prematurely, because at the same time, if you've got a company that's growing its asset base, logic would tell you that the bigger number this is, the lower number your turnover will be. So if a company is actually growing, you would expect sales or asset turnover to flatten out a little bit until sales catch up. So one of the companies in tonight's or this week's workshops has been able to grow its return on assets even though its asset base is growing, which is very cool. It's a completely fictitious company, but it's still a very cool result. All right? So if an asset turnover goes down, it may mean that the company is just expanding its assets and we just haven't utilised. Because right, you buy a new asset, it takes time for you to utilise, to work up to its full capacity. It might take a year or so before you start reaping the benefits of that expanded capacity. But over time, what you'd like to see is that there be a fairly short lag between expanding your assets and seeing sales and things like this turnover expand. They're just a couple of ways that you can start to analyse your non-current assets. So I think we've covered a bit. That brings me to kind of towards the end of what I wanted to chat to you about. Hope that's okay. The good news is it's 5 to 7. The even better news for you is I won't see you for another 2 weeks because next week is Easter. So have a happy Easter. Have a happy Easter break. Don't work too hard on the assignments, but work hard enough on the assignments, right? We are going to be here in case you need us. We are going to be here from when the university is closed Friday, Monday, Tuesday. So closed. You may be able to come in, I don't know, I'm not sure, but we're not allowed to come in on Tuesday. I will be here Wednesday, Thursday, Friday. If you want to see me, send me an email and I will organise a time. See you in 2 weeks, guys. Have a nice break.